This morning, at 10 o'clock Eastern Time, I delivered my first major speech since taking this role at the single most closely watched economic gathering of the entire year. Going into it, a survey of fund managers found 69% expected me to stay neutral, offering nothing new, nothing market moving, simply a steady reaffirmation of where things already stood. That is not what happened. Within hours, gold had fallen nearly 3%, its sharpest single-day drop in months, and silver fell even harder, dropping close to 4%. I want to walk you through exactly what I said, why it caught so many people off guard, despite this event being circled on every calendar for weeks, and why the specific way I chose to speak today may matter as much as anything I actually said. Here is the twist, and I am giving it to you immediately instead of making you wait. The sharpest market moves rarely come from genuinely surprising content. They come from a gap between what the market expected and what it actually got. 69% of professional fund managers going into today expected a neutral, unremarkable speech. What they got instead was me stating plainly that this summer's improved inflation readings do not convince me that the underlying trend has actually gotten better, alongside a clear signal that rates could still need to move higher if more real progress does not show up. That is not an extreme statement in isolation, but measured against what the overwhelming majority of professional money managers were actually positioned for. It was a genuine surprise, and genuine surprises are exactly what move markets sharply and quickly. The way you saw happen within hours of my speech ending. Before I go further, I want to know who is with me right now. Tell me in the comments where in the world you're watching from, and tell me honestly whether you expected today's speech to be neutral, dovish, or hawkish before it actually happened. I read these, and I promise you the pattern in the comments under a video like this always reveals just how many people were positioned for the wrong outcome, heading into an event this significant. Let me walk through exactly what I said today, because the specific language matters. I stated directly that while this summer's inflation readings came in better than expected, they do not tell me that underlying trends have meaningfully improved. I deliberately avoided offering forward guidance, explicit hints about the future path, and I just as deliberately avoided offering what is called a reaction function, a clear explanation of exactly what specific data would trigger a specific policy response. I describe my approach as one built around discipline rather than a fixed formula or forecast. And I explicitly pushed back on the idea that market participants should be looking to me for their next trading signal, arguing directly against the very dynamic that dominated how markets related to my predecessor. If you are finding this useful already, take a moment to like this video and subscribe, because the next part explains why the style of today's speech represents a real deliberate break from how this exact event has been used in recent years. And it is a detail that matters just as much as the specific words themselves. Here is why the style matters. At last year's Jackson Hole Symposium, my predecessor used those remarks to hint clearly at coming rate cuts, and markets responded with an aggressive rally on the spot. That is, the pattern markets have grown used to Jackson Hole as a moment for clearer signaling about the Fed's next steps. Today, I explicitly chose a different path, deliberately reducing forward guidance and reaction function clarity, hearkening back to an older style of central banking, where markets received less certain signals and the Fed itself played a smaller, less directive role in shaping day-to-day trading decisions. Whether or not you think that approach is wise, it represents a genuine philosophical shift in how this institution communicates, and markets that have spent years being handed relatively clear signals are now being asked to operate with meaningfully less of that clarity going forward, which is itself a source of the kind of volatility you saw today. This speech also landed in the middle of genuine, live geopolitical tension. The Strait of Hormuz actually closed yesterday, sending crude oil surging, even as Qatar continues pushing renewed mediation efforts to de-escalate the broader standoff. Gold itself had been on track for its biggest monthly gain since 1999 heading into today, fueled by the Treasury's own bond buyback intervention, reviving the debasement trade story I have walked you through in recent videos. All of that context, a market already running hot on inflation and debt, sustainability concerns, a live regional crisis pushing oil higher, and my deliberate decision not to offer the reassurance markets were positioned to expect combined to produce today's sharp reaction. Let me make this real with two people, because none of this matters until you see how it lands in an actual life. Neither is real, but both are the kind of person you might recognize. The first I will call Cuthbert, 71, who read the pre-event coverage suggesting a neutral speech was the most likely outcome and adjusted nothing about his own thinking. Heading into today, assuming the odds favoring a quiet, uneventful morning were reliable enough to simply ignore. When gold fell nearly 3% within hours, he was caught genuinely off guard, unable to reconcile what actually happened with what the consensus expectation had told him to prepare for. The second person I will call Henrietta, 68, and she understood something important heading into today. That when the overwhelming majority of professional forecasters converge on the same expectation, neutral, unremarkable, the actual risk sits specifically in the tail, the smaller chance that the outcome breaks meaningfully from that consensus. She did not know for certain that I would deliver a more hawkish message, but she understood that a market this heavily positioned for one specific outcome was exactly the kind of setup where a surprise in either direction produces an outsized reaction, and she was not blindsided when that is exactly what happened. The difference between them was never how much either one had invested. It was that one of them treated a strong consensus expectation as a safe, low-risk assumption, and one of them understood that a strong consensus is often precisely where the biggest surprises end up hiding. Now, why do so many careful, engaged people end up like Cuthbert, trusting a strong consensus expectation as though it were a guarantee? There is a simple reason. When the overwhelming majority of informed professionals agree on something, it feels statistically safe to simply adopt that same view without much further scrutiny. But a consensus, this lopsided 69%, expecting the same outcome, does not describe certainty. It describes exactly the kind of setup where the market has priced in very little insurance against the alternative, which is precisely why the alternative, when it does show up, tends to move prices as sharply as it did today. This exact dynamic, a heavily lopsided consensus getting caught off guard by a genuine surprise, is precisely what happened at this same event 1 year earlier, just in the opposite direction. Last year's Jackson Hole speech leaned unmistakably dovish, hinting clearly at coming rate cuts, and it set off an aggressive rally across stocks and precious metals within minutes, precisely because markets had not been fully positioned for that level of clarity in that direction either. The lesson sitting underneath both of these episodes: one dovish surprise a year ago, one more hawkish surprise today, is the same lesson repeating itself. This specific event has a demonstrated history of producing its sharpest moves, not when the speech itself uses extreme language, but when it breaks meaningfully from whatever the market had already priced in walking through the door that morning. Now, let me be careful and honest with you, because I will not insult you with fear, and this exact subject draws people who want to frighten or excite you into a rushed decision. My remarks today, while genuinely more hawkish in tone than the consensus expected, did not commit to any specific policy path, and I deliberately avoided locking myself into a firm signal about September's decision either way. Markets are still pricing meaningfully higher odds of a hike by December than by September, specifically, and it remains entirely possible upcoming data between now and the actual decision shifts this picture again before anything is finalized. A sharp one-day reaction, even one this size, does not by itself confirm where gold and silver head over the following weeks. Anyone telling you today's move guarantees a specific outcome from here is overselling you a certainty the data does not actually support. What I am giving you is not a prediction of where this goes next. It is the actual mechanism behind today's sharp move, so you understand why my speech, despite avoiding extreme language, still produced one of the sharper reactions gold and silver have seen in months. I want to say a word about silver here too, because its sharper percentage decline today, close to 4% against gold's closer to 3%, is consistent with a pattern I have walked you through in a recent video. Silver's generally higher sensitivity to shifting rate expectations, amplifying moves in both directions relative to gold. Today's reaction fits that exact pattern, a shared shock moving through two related but distinct markets, with silver once again showing the larger swing. So let us pull this together and go back to where we started. This morning I delivered my first major Jackson Hole address after 69% of fund managers predicted I would strike a neutral tone. Instead, I delivered a message explaining that inflation concerns remain unresolved. I deliberately avoided both forward guidance and a clear reaction function, choosing to break from the more directive communication style markets had grown used to in recent years. Within hours, gold fell nearly 3%, silver fell nearly 4%, and that sharp reaction reflected less about the specific words I used and more about how heavily the market had positioned for a different outcome beforehand. The difference between the people who were caught off guard today and those who were not comes down to one thing: understanding that a lopsided consensus expectation describes where the risk of surprise is hiding, not a guarantee against one. Here is what I want you to carry away from this. Stated as plainly as I know how. This is not a call to panic over a single day's sharp move. And it is not a call to make any rush decision today, because balance and clear thinking matter enormously, especially with retirement savings. It is a call to understand that today's reaction reflects a deliberate shift in how I intend to communicate less guidance, more discipline, and that markets will likely need time to adjust to operating with less certainty than they have grown used to in recent years. Whether this changes anything about your own plan depends entirely on your own circumstances, your own timeline, and your own comfort with a market that just demonstrated in a matter of hours how sharply it can move when a heavily expected outcome does not arrive. I am not here to tell you the number. I am here to make sure you understand exactly why today happened, not just that it did. Do not let anyone use today's sharp move to rush you into a costly decision, because there will be people trying, and they get louder every time a reaction this size happens. And do not dismiss it either, telling yourself a single speech in Wyoming could not possibly matter to your own retirement account, because you just watched it move gold and silver more in a few hours than most individual weeks manage on their own. Those are two different mistakes, and the sensible path sits calmly between them. None of this is financial advice. Every figure I have referenced, today's gold and silver price moves, the fund manager survey results, and the specific language from my speech comes directly from today's market reporting and my remarks themselves, so you can verify every word of it yourself rather than take mine. I opened by telling you that most of the market expected a quiet, unremarkable morning and got something very different instead. Now you understand exactly why that gap mattered so much. I chose discipline over guidance. I addressed inflation concerns that the market had largely assumed were fading. And I did so in front of a market positioned overwhelmingly for the opposite outcome. So let me leave you with the question underneath all of it. When the overwhelming consensus turns out to be wrong, and today it did, how much of your own plan is quietly resting on the same kind of confident consensus that just got caught completely off guard?